bit about some ways to acquire businesses with limited capital, and I know we have another speaker talking about other capital structures, but these are the two most popular ways I see businesses acquired. So the first category I'm going to talk about is seller financing. And seller financing is basically transferring the risk of a transaction from the buyer back to the seller. 90% of deals have some seller financing component to it, and typically as a percentage of the deal, it's between 10 to 100% of the deal value. So there's three types of seller financing of how I group them together at least. First is traditional seller financing, which is basically just a debt note. It's saying that, you know, I'm going to lend you X dollars over Y time, and you're going to pay me Z interest rate. And it's just a straightforward note. That's the simplest one. The one that I like the most is adjustable seller notes. So an adjustable seller note is it's that same note, but I'm going to have performance metrics tied to it. So if the revenue of the business declines by 20% the first year after I buy it, I can decline the balance of the seller note by the same 20%, or any metric therefore. I mean, in all of these, people ask, like, what's traditional? And I'm like, there is no traditional, depends on the deal. It's as creative as you can get with these types of financing structures. Earnouts they're usually in a separate category, but I consider it seller financing because the seller is still financing the deal. But an earnout is basically a 100% performance-driven payment method. So earnouts can be based on a lot of things, but typically you see them based on revenue or gross profit. And that's where the seller will get a percentage of the revenue over a specified time. Or I've even seen earnouts where it's what we call an either-or transaction. So either you'd set a target and say, like, the company has to do $5 million the year after acquisition, and either they hit it and the seller gets paid, or they don't hit it and they don't get paid. So these seller financing ones you can use on all kinds of transactions. You do see a lot of it with fixer-uppers. So if you're acquiring a business that has a lot of risk, this is how you mitigate that risk.